What's up, guys? Welcome back to DCA. So what we're going to do today is look at Bitcoin and the crypto market in general. So we have seen Bitcoin fall from a price of around $46,000 last week all the way down to where we're at right now at around $40,500. We're specifically going to be looking at the price action of Bitcoin after it moves below the 20, 50, and 100 week moving averages. So at the end of November, early December, when Bitcoin fell below its 20-week moving average, I made videos talking about how this is an ominous sign and how we've seen in the past that this tends to be pessimistic for future Bitcoin prices. Then in December, when we went below the 50-week moving averages, I really started talking about how this is a very bad sign, and in general, when we've seen this happen in the past, it typically leads to at least a longer period of time where we will need to go into an accumulation phase. So we're going to look at that today, and I'm going to show you how the price action we're seeing right now is entirely to be expected and what we may expect going forward from here. So what we see is that in every single market cycle in the past, events have played out nearly identically to the way that they're playing out right now. So I suspect it's very likely that we're en route to seeing something like we've seen in the past. Now, every time I make a video like this, I get comments saying that you can't look at the past to predict the future. The market is different now. That may be true, and I certainly hear that argument. However, I will say this. While it's true that not every single cycle will play out identically, one thing that will never change is human psychology. So while we're seeing certain behaviors of individuals, of individual investors, this plays out right in front of our eyes on the chart. And that's what we're seeing again right now. Individuals will always become scared and capitulate when prices are going down, when there's market uncertainty, when there's a general sense that an impending bear market is on the horizon. And that's sort of what's going on in the economy right now. There's a lot of macroeconomic uncertainty, and we've seen these positions before in the past, and we're going to show how these typically play out. Because quite frankly, in my opinion, nothing right now that we're seeing is unique to this market cycle. In fact, if you watch some of my prior videos, we've talked about on-chain analysis. And we're seeing right now where short-term holders have been capitulating. This has been going on ever since November. And this has happened at the exact point where we've reached market cycle peaks in the past. Short-term holders begin to capitulate. Longer-term holders at first will be selling a lot of the asset so they can make sure they lock in profits. They sell the asset, and then they begin to acquire the asset at much lower prices. Now, when they begin to do that, typically is at these stages when we're below the 20 and 50 week moving averages. But notice that when we're below those averages, we continue to trend down for some time after that. And sure enough, that's exactly what is happening again. We have went below the 20 week moving average. We went below the 50-week moving average. We bounced off of the 100-week moving average, and now we're moving down, perhaps back to the 100-week moving average. So we're going to look at how these events have played out in the past and what we may expect going forward. Now, what we're going to talk about, in my opinion, it's going to sound bearish, but in general, it's bearish in the short term. And when I say short term, if you watch this channel, when I talk about short term, it might not be what you mean when you're talking about short term. When I say short term, I'm referring to the months to perhaps a year type scale. So for me, that's short term. So when I say it may be bearish, I think that depending on how events play out in the general economy, this could be a position where we're at a prime opportunity for acquiring the asset. Now notice, prime opportunities for acquiring the asset are typically times where the retail market has left the asset. They're not interested because the price is falling. However, as we've seen in every single market cycle, the best times to acquire are when the price is falling. because in general, it's very short lived. It lasts for maybe a year to a year and a half. And during that time, you're going to lock in your highest level of profits when the price is falling down. When the price is moving back up, quite frankly, it's often too late. You've limited your earning potential into the next market cycle greatly, and you're basically missing the entire point of investing in crypto. It's offering you massive potential returns. So we're going to show how Bitcoin moves during the stages of these cycles, where we're at now, and where we may be going in short order. In addition to that, we're going to use a script that I've developed. And as usual, I'm going to try and post the script on the Discord channel. You could head over to the Discord channel to sign up for it for free. All the scripts that I make are free and they're available for signing up on the Discord channel. Okay guys, so what we're looking at here is the price of Bitcoin over time, obviously. And we're going back to about the middle of 2011 here. So what you see is in yellow, what we have is when Bitcoin is below the 20-week moving average. In green is when it's below the 50-week moving average, and in red is when it's below the 100-week moving average. All right. So on this script, what you'll do if you would like to use it, you'll just go up here and where there's this eyeball on whatever Bitcoin chart you have brought up, or any chart for that matter. This is not exclusive to Bitcoin. You just want to turn this off because this will give you it will allow you to see the chart better. Okay. So in the script, when you go to the settings, you have the price when that is greater than all, and that's going to be in blue. And then you have moving average 1, 2, and 3. And then you can do other options like if the price is less than all of the moving averages you select, and then if the price is less than moving average number 1 and number 2, okay? And you can change the moving average lengths right here in the input section, all right? So we're going to start by looking at when Bitcoin is below the 20-week moving average, and that's going to be in yellow. So when it's in blue, that means it's above all three, the 20, the 50, and the 100-week moving average. Then when we're in yellow, this is below the 20-week. And the first thing you'll notice, in general, when we are below the 20-week moving average, that is a very bearish sign. So you don't see very often that we're below the 20-week moving average and the price is moving up. In fact, it's sort of what we use on this channel to gauge when we've entered into a bear market, okay? So when we fall below this level, such as we did back here at the end of November or early December, you know, we've done nothing but go down from that time. In fact, if we just zoom in here, we've fallen from the time that we fell below the 20-week moving average, we've fallen now about 20%. So it hasn't been too terrible. But, you know, realistically, we started that week up here at around 57K, all right? And we fell all the way down to around 50K. So quite frankly, since we've officially closed a week below the 20-week, we're only down 20%, but you know, in reality, we're down actually much more, down to around 30%. So what we're going to do in this video is just take a look at, in the past, what has happened when we've got below these levels. And we're also going to attempt to answer several key questions. So we're going to ask how often, what percent of time does Bitcoin spend below its 20-week moving average? What percent of the weeks when you're below the 20-week moving average are you actually down? So in other words, if this week and next week we're below the 20-week moving average, how often when we're actually below it will a week close down? All right, and I think this is going to be surprising to people. And then we're going to look at when you're below these levels, what is the average percent change? So we're going to start with the 20-week moving average, and we'll just quickly look here how in each market cycle, when things have went from a raging bull run into a bear market, we've crossed below this 20-week moving average fairly early at the beginning of the downturn, essentially. So it's been, in general, a very good metric for defining whether the price is overall bullish or bearish. So you see that back in 2012, we're above the 20-week moving average. We got below for just a short amount of time in the middle of 2013. And then we went up to our second peak in this double peak cycle. We fell below the 20-week, got back above again for just a few weeks, and then came all the way down here. Then we went on our next bull run into the 2015 all the way through 2017 market cycle. We all know how that went. There were massive gains, massive FOMO into the market during the end of the cycle. The price went all the way up to $20,000 from a low, mind you, of about $200. In fact, a wick down to around $150. What happened was after this cycle came to this parabolic peak that we reached right here, then in the last weeks of January and early February, we started crashing below the 20-week. So we got below and had just another massive drop in price. In fact, going down around 75% from where we were last above the 20-week. Then in 2019, we got above the 20-week, but we were still, obviously, this gap here indicates that we were below the 50 and the 100 week. So we were below those. We got back above, had a mini bull run, and then came back down and obviously needed a reset at the COVID capitulation event. Then we went in 2020, we went up and then reached our peak in May and then dropped back below in May. We all know how this played out. Everyone who's watching this right now has probably been around, at least for this part of the cycle. We got above for a short time, went up to 69K, and then at the end of November and early December, fell back below, going from 57K all the way down to 50K in very short order. And now we're here at $40,560. Okay, so this just shows you being above the 20-week moving average is in general very bullish, while being below is exactly the opposite. Okay, so this is the numbers behind the data. So when we're below the 20-week, we showed it's very bearish. It's a very bearish sign. But how often are we actually below that 20-week moving average? Well, it turns out that we are below the 20-week moving average about 35 to 36% of the time. So 207 out of 587 weeks, we have closed below the 20-week moving average. Now, when we are down, so when you're down below this 20-week, what are the odds that the next week closes below where the prior price was? So what do I mean by that? Well, let's actually put the price back on itself. So we know we're below the 20-week moving average. What are the percent chances that the next week is actually a down week rather than an up week? And interestingly enough, it's actually only 49.2%. So you have about a 50-50 chance of being down the next week after you're below the 20-week moving average. In fact, over 50%, almost 51% of the weeks will actually be up weeks when you're below the 20-week. So while most weeks are going to be up weeks, the average price during that time, the average price change is actually 1.9% down. So per week, you would expect potentially a 2% drop in price over a long period of time. So even though most weeks are up, they will be in general smaller gains than the associated down weeks. So when the price goes down, you are expecting it to go down significantly more than you're expecting in the up weeks. Okay, so that's in general the case for the 20-week moving average. Let's move on to the 50-week moving average. All right, so in green, we have when we are below the 50-week moving average. Now, this is interesting and something that I think is very important to realize. When we're in a time when we've reached the end of a bull run and have fallen below the 20-week, we typically then will go down and test the 50-week moving average and go below it. And that is, again, what you've seen. We've moved below the 50-week moving average after oscillating between the 20-week and being above the 20-week. All right? You saw it here back in 2013. You saw it here. And then you're seeing it again right now. So we went below the 20-week, came back above, got above the 20 week for a short amount of time. In this case, it was a bit longer than in the past. It was a few months. Although if you go back here, it was about a month and a half or 2 months even back in 2014. So not that dissimilar. The one difference being that we did get above our prior all-time high, which is a unique, that's a unique aspect of this particular market cycle. Although the case could be made that this was a heavily manipulated market, in addition to the fact that the money supply was just through the absolute roof during this particular run. Although, that's neither here nor there. The reasons don't really matter. The fact is it went above our prior all-time high, which was a unique event. Other than that small anomaly that occurred, we're seeing exactly what we saw in the prior market cycles. A short time above the 20-week moving average after falling below it, and then right back down below the 50-week. A short time back above, just a week or two, and then right back down to the 50-week moving average. Okay, same thing here. We got above the 20-week, fell back below, got above for a short time, and then down to the 50-week. All right, and now here we are. We fell below the 20-week, got back above, right back below, down to the 50-week. Okay, so, like I said, nothing unique is playing out here beyond the fact that the price went to a new all-time high. We're seeing identical behavior in the price action as we've seen in the past. Now, let's take a look at the numbers behind the 50-week moving average. Okay, so here we have the 50-week moving average and comparing that to the 20-week. And what you see is, so, when we spend approximately 35.6% of the time below the 20-week, we're only below the 50-week about 30% of the time. Now, when we're below the 50-week, what are the odds that we go down the next week? And then, it falls to 47.1% actually, which is interesting. And in fact, if you look here, the percentage drop in price actually is decreased. So when you're below the 50, at first glance, it looks like you're actually better off than you are when you're, just below the 20 week. But that's not actually quite true. And we're going to show quickly why that is. So let's go back down to the chart here and let's hide this and just show our 50 week. Well, notice that the 50 week is a much more sort of stable moving average compared to the 20. The 20 will move up, wild swings up, and then more wild swings down, okay? So when you get below the 20 week, notice how once you reach the bottom, that's likely where you'll come kind of back above the 20 week. Whereas with the 50 week, you can reach, let's hide the 20 week here. You can reach the bottom and then kind of start going up for some time before you get back above it. So this skews the data slightly. This kind of makes it look like being below the 50 week is better than it really is. And that's because, you have all this time, since this moving average is harder to sort of move around from its baseline, you have more time to start going up and then come back above it. So a more accurate measure of this is to say, when you're below the 20 week and the 50 week moving average, what are your returns? And that will give you a better idea of, where the actual returns are coming from when you're below this 50 week. Because notice when you're below the 20 week in yellow and the 50 week in green, these are typically very bad times to just be sitting on the asset. Now, when I say bad, I mean your returns are bad. They're in fact actually some of the best times to be buying the asset. Let's just look, back in 2014, when we were below the 20 week and the 50 week, you could have been buying anywhere from $500 all the way down to $150. Not bad when you go up to 20K in the next market cycle. And again here, you could have been buying between 7,000 all the way down to 3,500. Not bad when you go up to 69K. Same thing in the COVID capitulation event. So typically you experience drastic price drops when you're below these two moving averages, but they tend to be the best times to buy. So let's look at the actual numbers behind it though. Okay, so here we have the times when the price is below the 50-week moving average and the 20-week moving average. And what you see is we're only below both approximately 25% of the time. So 135 weeks out of 557 weeks. Now notice these levels are slightly different, the denominator, simply because you need 50 weeks of price data to have a 50-week moving average. So obviously you need 30 more weeks than a 20-week, okay? So when we go below the 50-week, what are the odds, or when we're below actually the 50 and the 20-week, what are the odds that we're down the next week? And that actually happens less than you would expect. It's only 43% of the time you're down. So you're actually going to be up most weeks when the price is below both of these moving averages. But here's the caveat. Even though it's actually up most weeks, the average percentage that the price is down is actually almost 4%. So it may be up some weeks, but you just have these massive price drops when you're below both the 20 and the 50 week. So now we're finally going to talk about the 100-week moving average. So the red color simply signifies when we've fallen below the 100-week moving average. Now notice that it goes sequentially in each market cycle. You get below the 20, you come back above the 20, then you go below the 50, then you trend down to the 100-week, and you stay there for a while and you grind sideways during this time. Now, typically, when you are below the 100-week moving average, let's look here and let's look here. So notice that they sort of played out identically to one another. So this one lasted from December of 2014 all the way through November of 2015. Okay, so this one lasted November of 2018 all the way through April of 2019. So this one was about 5 months, whereas this one we were below from December through November of 2015, so nearly a year. But notice that, once you got below this level, once you got below this 100-week moving average, it went down very quickly. It went down below it very quickly, and when it got below, you really, if you just held on to the asset, you sort of never got much lower than this $220 level, at least as far as closes go, weekly closes. So we came down quickly, and then you had a lot of time to buy the asset right in this range at just amazing prices. The same thing happened back here. These events, when you go below the 100 week, are typically massive capitulations. Okay, the last thing we're going to do then is take a look at times when we're below the 100 as well as below the 50 and the 20 week. And these are your most severe cases. As soon as the line becomes orange, that's when we get below all three. All right, so we're looking like right here, and back in 2014, December of 2014, this is where we essentially went from $350 all the way down to $200. And in fact, if you just bring the price in, we wicked down to $164. And then again, this happened here in 2018, November of 2018. So we went from a price of around $5,608, and this is the week of November 12th, all the way down to around 3260, and this is the week of December 18. And this was pretty close to exactly at the bottom. All right, notice how we basically wicked almost down to this 100 week moving average. I could see us getting back to that kind of level again. Notice the 100 week is moving up with time also. When we almost got there previously, the 100 week was at 31,600. And we got all the way down to the low of around 33,000. So how does it typically play out when you go down to the 100 week? Well, I don't think there's necessarily a playbook for how this works, because in this case, back in 2014, we rode along the 100 week for some time. In this case, in 2018, we just capitulated below it, and then capitulated below it 2 more times, both in 2019 and then in 2020. So, I do suspect that we are not done interacting with the 100 week moving average. But let's go look at the numbers again and see what, these numbers can tell us. So In these times when you are below, like we said, when you are below the 100, the 20, and the 50, you typically get very severe corrections. But remember, these don't happen for very long amounts of time. In fact, they only happen 12% of the total weeks of Bitcoin's existence. And when they do happen, you're down around 5.6% per week. But if you go back and look again, let's get rid of this and let's just look at times where we're below the all three of the moving averages. So here, here, and here. You actually don't go down, it's 5.6% per week, but a lot of that is just because you typically drop below this 100-week moving average with a capitulation event. So it's sort of skewed in that sense. So the 100-week being below it tends to be just an incredible time to acquire the asset. It tends to be when the retail market is just absolutely gone. They're doing whatever they're doing, not investing in crypto though, and not watching crypto YouTube, especially not watching channels like mine, because I don't know, maybe they're watching Mooncoin videos still, but they aren't buying Bitcoin when Bitcoin is down at $3,500. The smart money is buying Bitcoin. The guy who bought, nearly 2 million Bitcoin at a price of around $4,000 and has decided not to sell it yet. People like that are buying Bitcoin when the price is at these levels. All right. So, at the end of the day, it takes conviction and it takes a lot of willpower to, buy into an asset that is getting hammered like this. But they tend to be the absolute best times to buy. Now, with that said, we do have more players in the game today, like Michael Saylor, who, I suspect is probably going to start buying every time we get near this 100-week moving average. But that doesn't preclude it still from going down to some of these lower levels. So, I can't say definitively that we will go below the 100-week moving average, but it's at least something you need to consider. You at least need to consider the fact that, quite frankly, there is a lot of macroeconomic uncertainty in the markets right now. And if you think that we're immune from it somehow, you're wildly mistaken, I assure you. If the stock market continues to crash, continues to plummet, that's going to come due for crypto as well. Remember, we have been, doing nothing but going up basically ever since Bitcoin was created. The stock market has essentially just gone up, just like Bitcoin. So a large correction is, very likely to come due for crypto as well. Now, like we said, there's a lot of new players in the game. The market is much more mature at this point than it was back in 2018 and back in 2014. But nonetheless, you're seeing, if we just bring this up one last time, you're seeing the situation play out in a way that is in no way unique from anything we've seen in any prior cycle. You're seeing identical behavior to what you've seen each time. And I don't anticipate that it's going to wildly change from here. Now, we may not have this type of severe correction again, but you know what? People were saying that we weren't going to go from 69K all the way down to 33K either. So people can say whatever they want. At the end of the day, I don't care what people say. I care about the data. That's it for this one, guys. Until next time, as usual, see you.